chapter is about securities and securities regulation. Security essentially means something that is publicly traded in the open market, usually a stock, but it could also be something like a bond. Until 1929, securities were pretty much unregulated, which means pretty much anybody could sell any stock they wanted on the open market, and there wasn't much in the way of government regulation. And all that kind of led to the stock market crash of 1929, which led to the Great Depression. Until 1929, the stock market was doing very well throughout the 1920s. The 20s were called sometimes the Roaring 20s because the economy was doing so well, but a lot of that was based on a mirage. A lot of that was based on the idea that these stocks were overvalued, and people didn't realize how the underlying companies really weren't worth as much because the companies didn't really have to provide any information. And that all changed with the securities rules that were passed in 1933 and 1934. These were called the SEC Acts. They created the Securities and Exchanges Commission, the SEC, and also provided a bunch of rules regarding how you can sell securities in the open market, how you can sell stocks. The goal of the securities rules is really about disclosure and accuracy. Disclosure in making sure potential investors, including banks, mutual funds, and individual investors, know a lot about the information, know a lot about the stock, know a lot about the company before they actually decide to invest. And number two, that the information that is put out by the company is accurate. The goals are to assure accuracy and completeness of information given to the public, organize a system where there should be full disclosure of accounting information, companies' profits, companies' losses, companies' expenditures, and to regulate forms in which securities are exchanged. In other words, to try to avoid companies being worth more than they're actually worth because of bad information that is given to the public, or because of a lack of information that's given to the public. And these are administered by the SEC. The SEC was first created in these acts of 1933 and 1934, and of course exists to this very day. The SEC, the Securities and Exchange Commission, is a federal administrative agency run by the executive branch of the government that what it does is it enforces and administers federal securities rules. It can adopt rules and regulations to interpret and implement federal securities laws. Federal securities laws are fairly complex, but the securities that they govern in the entire stock market is almost infinitely more complex, and so therefore the SEC has to make judgments on the fly and pass regulations, as many administrative agencies do, to make sure that the goals of the securities rules and to make sure that the enforcement is up to standard. It can investigate securities violations. It can bring enforcement actions. In other words, it could bring actions against people who allegedly violated the securities rules. And it can also regulate activities of securities brokers and advisors. So let's take a look a little bit more in terms of what securities are and a little bit in terms of details of the securities rules. We could spend whole courses on securities, so obviously we're not going to discuss it in too much detail, but we'll discuss kind of a brief overview, a little bit of a survey of some of the securities rules. First of all, in order for the Securities and Exchanges Commission Act, or the SEC Act, to apply, it has to be a security. That's the first thing. So, I guess the first thing you have to do is define what a security is. A security is any interest or instrument that is a common stock, preferred stock, a bond, debenture, or a warrant. We discussed what bonds and debentures were. Those are debts of the company that are being sold to individuals, when basically an individual is lending money to the company. A stock, common stock or preferred stock, is a share of the company's ownership. And a warrant is really a right to buy a stock at a certain price within a certain period of time. Kind of like an option, but, well, a little different. We don't have to go into that in too much detail, but the point is something like, well, you may have heard warrant in terms of a search warrant. This is an entirely different type of warrant. A warrant may be a right to buy a particular stock at $10 anytime over the next year, or something to that effect. Very often they come with stocks. When you buy a stock, you may also buy a warrant, depending on the company, but that's essentially what a warrant is. It can also be an interest or instrument that is expressly mentioned in the Securities Act, or it's an investment contract. These are all examples of securities that are regulated by the SEC Acts and the SEC. So, the Securities Act of 1933 regulates the issuance of these securities, And what it says is that when you're going to issue a security, in other words, when you're going to start selling things in an open market, you don't have to worry about the SEC, you don't have to worry about the securities rules if you're just a private company. You have to worry about other rules, of course, but you don't have to worry about securities rules because you're not being sold on the open market. If I, on the other hand, have a private company and I want to start issuing these shares to the public, and issuing these securities to the public, well, then I have to start worrying about securities rules. And that's because Section 5 of the Act says that securities that are offered to the public through use of mails or any facility in interstate commerce, which of course in today's day and age includes computers and includes the internet, includes pretty much anything you can think of, because the internet does go in interstate commerce. When the Act of 1933 was originally passed, as hopefully you can understand, there was no internet, so they couldn't really discuss the internet in 1933. But the point is, you do have to register with the SEC before you issue any of these securities to the public. And the way you do that is through a registration statement. A registration statement is filed with the SEC. It contains information about the securities to be issued. And what the SEC is looking for is not whether it's a good stock, it's not whether people should buy it or anything to that effect. That's the sort of thing that the individuals will decide, so that's not the sort of thing the SEC really worries about. What the SEC does worry about is whether the issuer has met the disclosure requirements. In other words, that the issuer, the seller, has to establish that the securities disclosure requirements, statements that are required to be made to the public, are actually done. Then you have what is called the offering process, sometimes referred to as the IPO process or initial public offering process. And the way this is, if I have a company and I want to start issuing shares in public, like Facebook did a few years ago, like many of the big companies have done, they are originally private companies that are held by a few individuals, and now all of a sudden they want to start selling stock on the open market in order to make a lot of money, and very often these companies do make a lot of money, hundreds of millions or even billions of dollars by selling stock. So there's a process. Now it's a complicated process. It may cost $10 million in legal fees and in the fees of investment banks who actually set up the offering process. But if you're going to make $200 million or $1 billion, then it may be worth it to spend $10 million to law firms and investment banks to help set up this process. So the process is, first of all, disclosure, which is a full and complete disclosure of all sorts of information to the SEC and to the public of the company's finances, business, prospects in the future, and the organization of the business. It requires that the company get its books in order and make sure the accounting is up to date through a whole series of complex rules that govern securities. And once it does so, it can go public, and it has to issue what is called a prospectus. The initial public offering is the process by which the stock or the security is originally offered to the public, and they have to create a prospectus. Now, if you've ever invested or if you've ever seen a company that was invested, you may have heard of this prospectus. A prospectus is usually a long document, and the document gives all the disclosures. Sometimes these companies will say, read the prospectus carefully before you invest. Now, most people don't actually read the prospectus carefully before they invest, but the point is this information is there. And it's one thing if you're going to invest a couple of $1,000s, you're probably not going to bother to spend 5 hours reading the prospectus. But if you're a mutual fund manager and you're thinking of investing, $25 million in the company, well then there's more of a reason to read the prospectus carefully before they invest. And this contains all of the information that is necessary. It has to be looked at. First of all, it has disclosures, explains how the company is organized, gives investors information. It has to be read and approved by the SEC. The SEC hires people that sit there and read prospectuses to try to make sure everything is appropriate and everything is disclosed and everything is discussed. And a prospectus is a disclosure. A prospectus is not an advertisement. It's not to try to condition the market. The idea is if a prospectus is too much of an advertisement, if it's trying to be an infomercial, if you're trying to sell the company in the prospectus, well, the SEC might say, rewrite this paragraph. Don't write about how great you are. That's not the purpose of a prospectus. If you want to run a commercial or if you want to advertise, you can go ahead and do that. But that's not the place of the prospectus. The place of the prospectus is to explain to the public what is going on. There is one section called the management's discussion and analysis where the management is allowed to speculate a little bit as to the prospects of the future, but it can't be too much like an advertisement or the SEC is going to make you rewrite that paragraph.